Hey, my name is Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, I'm giving an 8-month update. I haven't made a video in 8 months, and I just wanted to kind of update you guys, see where I'm at. I didn't die or anything like that, just really busy with full-time work, a master's program, family, things like that. So I just want to go over my portfolio, kind of all the different changes that I did, and I think you would all enjoy seeing kind of where I'm at right now and kind of my little adjustments to my strategy. In my previous videos, some of you may know that I used to invest in a bunch of income generating ETFs. I have veered away from there, and now I actually sell the options myself. So if one would say what my strategy is in my brokerage account, it's kind of like a three-prong approach. This three-prong approach is invest in a high-quality asset, and ideally this asset will grow over time. And in doing so, what you do is you sell options against those assets that you invest in. And then because this asset is growing, then you can actually use margin to optimize that gain, which essentially is like a wheel strategy. So what I'll do is in my portfolio here, I own Tesla. Again, you could own anything, whatever you drink the Kool-Aid on. Pick a stock that you feel is going to grow, has great leadership, and has a huge run rate for growth. You invest in that company, and what I do is I sell options against it. So right now, my current portfolio value is $462,000. If you look over the last year, Tesla has finally gone up. So it's up about 88%. Now, this is kind of interesting because, a lot of people say that Tesla's not a good investment, things like that. And, oh, you just got lucky because it's up. This is not luck. I have been investing since, let's see here, 2021. And since 2021 up until 2025, my portfolio has pretty much been flat. I've been trying to do all kinds of crazy strategies to try to optimize my gain, but ultimately the best strategy is to invest in a high quality holding and hold it over time. So what I'm doing here is, so I own this Tesla. And what I do is I try gaining 5% of my portfolio value in option income. So for example, you'll see I have 11 calls that I'm selling here, and I have 6 puts over here. So ideally what I do is I sell covered calls against this, and then I run a wheel strategy using margin. So for example, my Tesla position, my account's worth 462,000. So what I try doing, so 462, 1, 2, 3, and I want to get about 5% a year in income. So if I get about 5% a year selling covered calls against my Tesla position, I should gain an extra $23,100. One of the beautiful things about doing options yourself is that when you own dividend ETFs or these high income funds, every time you get a distribution, it subtracts from the share price. So ultimately, if you get paid $100 distribution, then that's what it would subtract from your share price. Or what, for example, like say, the distribution's $1. And the share price is $20. Now the shares will be worth $19. So you're not really actually getting a gain. You're just getting your money paid back to you. Whereas if you do the options yourself, you're actually getting the gain. So the premium doesn't get subtracted from a share price or anything like that. So ideally, my first prong in the strategy is, I'm investing in a high quality holding, and I'm going to hold it for the long term. I'm not trying to get rid of this. I'm just selling covered calls against it. So goal is to make 5% on the holding. So that's $23,000. If you divide that by 52 weeks, I pretty much need to generate $444. So if I own 11 shares, I just need to sell options at about $40 a share. So what I would do on any given week, and I sell weekly options. So on any given week, I will be selling, options. So what I do, I would trade Tesla. I would sell a call. And remember, we said $40. Let's just go to 41. And what I would do is I would essentially sell this. Now, when I did it this morning, this is kind of where I was at for the 5%. But for example, like if I were to get in the position now, I would probably pick either one of these just to kind of look at this. I'm not really aiming for a certain delta, but ideally I would like a delta under 5, because the delta signifies the likelihood of your options being assigned. So if there's a 4% chance or a 4 delta, that means you have a 4% chance of getting your options assigned. So I would do that, and I would make my $444. So very easy. Again, this isn't like a super complicated strategy. And ideally, the point is to optimize the stocks that you're holding long term. So that's the first 2 prongs in strategy. So you're holding a really great investment, and then you're selling covered calls. Guys, honestly, it's literally that simple. And I'm going to show you my spreadsheets on how much I made, because I made over like 70, maybe $80,000 selling options. And then I got lucky with 2 plays, and I'll discuss those where I made like $50,000, but we'll talk about that here in just a moment. And then the other strategy is here, I own Tesla, and what I do is I use 50% of margin collateral to sell options against Tesla. So for example, my portfolio is worth $462,000. So 50% of that, so 462, 1, 2, 3, divided by 2. So 50%, so $231,000, I sell cash secured puts against my portfolio. So, they're not really cash secured puts. I would more so call them collateral secured puts. And what I would do is, I would sell pretty much half to gain some income. So I have 1,100 shares of Tesla. So let's just see how much shares I can buy if I sold cash secured puts with 50% of margin. So share price is 465. So I could buy about 500 shares worth of collateral. However, I upped it to 6. So essentially what I do is, let's get our calculator back here. So, when selling covered calls on my purely covered call strategy, my goal is to make 5%. On my cash secured put covered call wheel strategy, my goal is to make about 10%. So 462,000 times by 0.1. So I'm trying to make $46,200 a year. And if you divide that by 52 and you divide that by 6, so about $148. So what I would do is I would trade Tesla. And then now we're going to be selling puts. So we are going to be acquiring income, and that does open up a margin position. So again, I will be using margin collateral. However, I'm getting paid to buy Tesla at a really good price. So for example, let's just say 150. So it kind of puts us here at this. So this is kind of exactly where I'm selling my cash secured puts to do the wheel strategy. So if you click on this and you look at the delta at a 13 delta, that's actually very low likelihood of being assigned. So ideally, over time, I just keep, acquiring this premium with the options expiring, and there's not really much you need to do with that. So again, I did that, and you'll see here overall today I made about $2,000. Simple strategy. And then the final thing I would like to mention is, probably sometime in October, I used to own these, I was selling covered calls on Tesla, and because I had to keep rolling them far out of the money, I decided I want to buy those options back. And if you look in the investing portfolio, it cost me like $90,000+. Now I have it paid down to $48,000 with the weekly options. So they've been paying it down very nicely. And as you can see here, if you go to margin used, I only really have $48,000 of margin because I bought back that position. And then my margin maintenance, $392,000. Now, this thing is, when you're selling collateral secured puts, it's a one-to-one margin. So if you borrow $250,000, then this is going to reflect $250,000 for your margin maintenance. Plus, there's another calculation they do. So you can see here, $265,000 in option collateral plus the $48,000, plus I think Robinhood taxed on another $40,000. So this is my margin maintenance. Now, say my shares do get assigned. So say, I'm using collateral secured puts. Say these puts do get assigned. So I'm buying Tesla at a really good price, and say they do get assigned. Now, instead of having 100% margin balance on it, it would be dropped down to 25%. So then technically my margin maintenance would go down. And then ideally what would happen is, if I get these assigned at such a good price, what I would do is I would go ahead and sell them at the money after they get assigned. Okay, let's go to the spreadsheets here. So overall, this is, let's talk about the covered call strategy first. So again, I have certain goals that I want to achieve selling covered calls in my positions. My goal is to make 5% a year. I started the year with my account being $280,000. Now it's $465,000. That's a testament to the option plus the share price appreciation Tesla. I guess the final point that I want to make here is let's just look at the 1 year. So my portfolio has gone up over 88.56% this year. If I just look at Tesla in itself in the 1 year, you're going to see that using the options to optimize the gain is pretty crazy. So if you look here, the gain for Tesla is only 11.16%. The fact that I'm selling these options against my position, so doing the covered call strategy, but then also doing the wheel strategy, has optimized my gain for up to 88%. And then if you're going to compare it to even say the S&P 500 or the triple Q, the gains are even more drastic. So in the last year, And last year's, the S&P 500 is just 16%. I'm up 88%. So, we're drastically outperforming the market. Now, obviously, there's always risk to not necessarily selling options, but then using the margin is a little on the riskier end. However, if you're doing it in a safe manner, then, you're using 50% of your total portfolio value in margin. Like, my portfolio can drop 50%. And I would still not even be margin called, because then the shares would get assigned and then I'm still 1-to-1. And then again, looking at triple Q here, the gain is over 20%. Again, I made 88%. So this is kind of crazy, the amount of gains you can get. Just doing a very simple strategy of gaining an extra 5%, selling covered calls against your baseline position, and then just doing a cash secured or collateral secured put wheel strategy. So you see here, the covered call strategy. So I bought my long leaps back in October 2020. So you can see here, I wasn't going like heavy into selling covered calls against my position because I actually didn't have the calls to sell against. But then here, on the 20th, I bought the calls back. And then ever since then, I've been selling about 11 covered calls on Tesla. And you can see here, I've made about $11,254. I did not have to roll any of these positions. I have not been assigned any of these positions. And as you can see here, the deltas are on the lower end. So today's delta that I did was about a 7 delta. The goals here. So again, this is the covered call strategy which is more so that two-prong approach. So, we're owning an investment and we're never trying to actually sell it. We're just trying to gain income. So the number one goal is always the price appreciation. The growth or the income is second. If I got no income, that is fine. I was going to hold this anyway. So if I have to end up in a scenario where I have to keep rolling a position to get income, that is fine. I was going to own it and not sell options against it anyways. At least now getting a 5% of income off of my overall portfolio is huge. Like, you're not going to get 5% in a savings account. You're not going to get it in like bonds or anything like that. Like, getting a 5% in income is actually pretty solid. However, you are going to have to pay, capital gains tax at your income bracket. And I guess that is the downfall to it. However, but getting 5% is still better than getting like a 2 or 3% return. And then, here, this is kind of interesting though, because my last deposit in this actual brokerage account, in this account here, was almost 2 years ago. So my last deposit was May 29th, 2024. The majority of the growth of this account has either been from my option investing or the actual share price appreciation of the stock. So this is, dollar cost averaging is such a powerful tool. I still do that in my Roth IRA, but I told myself that in this brokerage account, I will not be putting any more money. I just want to see if I can personally grow this account with the share price appreciation as well as the option investing. And so far, it has been doing so nicely. And then there's another point that I'm going to make is hopefully in the next couple of weeks when my rental property will sell, I realize I can make way more money just selling options than I can this rental property. Now, there's a whole bunch of tax benefits doing the rental property, but since I am in school, and then I'm going to go back to school where I'm not going to be able to work for 3 years, I really kind of need this income now. So I'm trying to optimize this entire portfolio so that when I do go back to school and I do have to put my full-time job on pause, I can actually live off this, which would be interesting. So, it'd be an excellent thought experiment where, watching me actually live off my money. And then ideally, like any money I make in this account, I just keep it as cash in the account until taxes. If there's anything left, then I can buy foundational shares. So that's kind of like, this is my covered call strategy. This is, investing long-term in a really good company. And then the cash secured put wheel strategy. So we're using margin to generate income. So ideally, we're using other people's money to generate income. So think of like a rental property. Everyone has no problem borrowing money to put money in the rental property, but then to borrow money to invest in stocks, people think that it's so risky. If you're doing it in the right manner, it is actually pretty safe. Okay, so from overall here, my goal is to make 10%. So these are the goals that I look for. So using margin to generate income. So the goal is to make 10% a year selling cash secured puts or covered calls. So we're using 50% equities collateral. So the reason I made this specific rule is because if I'm in a position and I'm selling cash secured puts, the delta is already at like a 13 or a 15 when I'm selling these cash secured puts. So if the price of the stock drops down to that point, I should be buying in such a good price. If it continues to drop more, again, I'm not overextending myself with leverage. Some people go heavy in leverage. That's on the riskier end, but it also depends on what you're owning. Like, for example, like if you're owning Tesla, you shouldn't be going 100% of leverage. That's a recipe for disaster. However, if you're owning like the S&P 500 or the triple Q, you can go 100% into like, selling cash secured puts against your positions, because it's not going to move as much as like a Tesla will. So, I use 50% of equity as collateral. So again, what does that mean? So my account is, again, $462,000. I will only borrow up to $231,000. So 50% of my total account value, I'm getting that. And then, again, for this make 10% a year selling cash secured puts, covered calls, that is supposed to be off of the yearly amount. I'm not trying to make 10% every week or every month, because that'd be crazy. I mean, those gains would be fantastic, but that's not my goal. Again, I'm trying to get a little bit of gain here, but I'm also trying to buy things at a good price and then offload. So then again, if I'm trying to make 10%, that's $46,000 a year plus, $23,000 from the other strategy, $69,000, $70,000 a year of not really having to do anything that difficult to make is awesome. Like, I'm not using my own money to generate this extra, $46,000, but then the $23,000 that I did invest with my own money, or the Tesla shares that I bought with my own money, like I'm able to generate $23,000 a year. That's awesome. Like, this is some people's full-time salary, and I generated that over a year. And actually, I didn't even do that over a year because I started it in late March. So then, I made over $52,000 selling the actual option premium. And then, as you can see here, I have made well over $20,000+ from the actual capital gain. So ideally, if my cash secured puts do get assigned, then I immediately, as soon as I get them assigned, I try selling them at the money to offload them so I can go back to selling cash secured puts. Again, the goal is only to make 10%. When I sell at the money, it's obviously I'm going to be making more money, but the overall goal is to make 10%. As you can see here, I did have one capital loss. I'm going to chalk this up to a scenario where I was at work. The market was closing, and the share price of Tesla just closed right above, like I can't remember. It was like I was selling covered calls with a strike price below my cost basis, which I will never do again. And I was supposed to roll it up, but then work got really busy and I was not able to actually roll that up. And then I did end up losing 7,500, but then ultimately long term, I got the 7,500 back plus extra, and then a couple other wins here. So honestly, like if you chalk down the 7,500, I should really tack on another $7,000. So this should be 80,000. So 73,000 plus this 11,000, is $84,000. So then overall, I did start the year investing in these covered called income funds, and honestly, I didn't like the tax advantages for them. They're not exactly what they said they were out to be. They didn't say that. I just not a fan. Like, I don't like the NAV erosion. I don't like that, if you get a $1 distribution, the share price goes down by $1. When I make option premium, I'm not losing $1 for every single time I'm putting these trades in. So I think overall, the approach that I'm taking is a little bit more optimized than this. And again, no one's going to care more about your money than you. So having someone else optimize it, it's a lot more work, but then also you're in a lot more control. And then earlier in the year too, in February, there was a whole bunch of negative hate on Tesla. And I immediately tried taking this opportunity to sell puts against Tesla. Even though I'm a long-term bull on Tesla, just in the short-term price movement, I did sell options. So one of my first put options I bought. I hate buying options, but this opportunity was too good to be true. I went for it and made $10,000. After a couple days went by, I went back in heavier and I made $43,000 buying a put option on Tesla. So this is a lucky trade that I think will never happen again. These two trades took all of 3 weeks and I made a substantial amount of money. Whereas my other strategy here, like selling the weekly options, is a strategy where like you're chipping away, but then this strategy is substantially safer. If I'm sitting there looking at a screen trying to make $43,000, that is cancer to the brain. Like every single day, I went $80,000 in margin for this position to make the $43,000. And every single day I was like, oh my God, like this is so crazy. Made the money. And I said, I am never doing this again. And then I really refined doing the wheel strategy, long-term cover calls. And that's kind of where we're at right now. And then what'll be interesting too is my estimated tax for these positions is about $45,000. So hopefully by the end of the year, like it'll still be a gain of $105,000. So let's just pull that calculator back up. So, if we made $105,000 divided by 464, 1, 2, 3, I mean, that's still a 22% gain from the actual income in itself. So if you're making 20% a year, and every 5 years, you're going to double your money. So again, I'm not doing anything groundbreaking. I'm making 5% on a covered call strategy and 10% on a cash secured put strategy. I mean, that is pretty straightforward. And then my final thing I'm going to discuss is, obviously when you look at an account like this, like it's 460,000, you're like, you kind of get discouraged because like, wow, I'm never going to make to that point. If you guys see on my YouTube channel, if we go deep into the archives, I think my account started at $28,000. 5 years ago, my account was $28,000. You pick the right investments, you keep dollar cost averaging, your money can grow. Like I'm showing you that it is possible to grow your wealth. Now, one of the most important drivers to growing your wealth is you need to increase your income as well. As these years have been going on, I've been picking up a lot of overtime. My yearly income has been increasing just from, being in a union job and, getting the guaranteed raise every single year. But, if you're in a position where you're not making a lot of income, your number one priority should not necessarily be investing. It should be increasing your income. Like that is the fastest way that you're going to grow your wealth. Then, if you have any leftover money minus, your expenses, then you can go ahead and invest that. But the biggest thing is investing that or increasing your income. And then ultimately what I also did is I used to have this dividend strategy in my Roth where I just owned the SCHD and SCHY, but then I rolled my M1 Finance account into Robinhood. And what I'm doing is I bought Triple Q. My account position is about $65,000. And I'm kind of doing this, I'm going to call it like a small account challenge to see like how much extra income you could generate just from, the small account. And again, the same goal here is like, I'm trying to own the Triple Q for the long term. Like these are really good companies that are, innovative and that they are the future of the United States economy. So I would like to own all of those, which is why I'm owning the Triple Q. And then ultimately, I would just want to get my 5% just holding the position. So again, I'm getting 5%. It's in a Roth. It's going to be tax-free. And, that 5% I get every single year is not going to be taxed on anything. So then, every single time, every week that I buy or sell these options, I get the money. So this week I made $50. If someone hands you an extra $50 to invest every week, you'd be pretty happy with that. Right. So, I mean, this is just kind of like the state of where my portfolio is. So, we did have a change in strategy slightly by not investing those income funds. However, the overall arching themes of investing high quality holdings for the long term hasn't changed. We're still optimizing our gain, but we're just doing it in a much safer manner, getting 5%. And then instead of using debt to invest in income funds, we're using the debt to actually sell the options ourselves. And then we're selling the options at a point where it is super safe, where you're getting them assigned. And then if they do get assigned, you can just sell them right at the money, hopefully offload them real quick, and then go ahead and continue selling cash secured puts. So this is kind of like the overall strategy. Again, I'm going to try making update videos, but again, life gets busy. So like I didn't die or anything like that. I'm just a busy guy. But yeah, we made $73,000 a year. So I'm just going to kind of slowly scroll through here. So if you really are trying to analyze the numbers and kind of see what I did and what deltas I use, you can go ahead and take a look. But these are all the weekly trades that I did. Yeah, and that, the last couple months was huge because the Tesla share price oscillated within a range. So I kept selling at the money calls because I was assigned at some point. I was assigned at this point, and I kept selling at the money calls, and the share price kind of stayed the same. So I was kind of raking in a good amount of cash. So, but again, this is kind of this is the plan. This is what I'm doing going forward. Hope you have a good one. If you have any questions, definitely ask.